Hi there. In this video, I'm going to be looking at financial strategies, but more specifically, the working capital or liquidity management strategies. So firstly, what is working capital or liquidity management? So short-term liquidity is extremely important for businesses. It means a business can take advantage of profit opportunities when they arise, as well as meet their short-term, within 12 months, financial obligations. A business must have sufficient liquidity so that cash is available or current assets can be converted to cash to pay debts as they fall due. The lack of short-term liquidity could necessitate the sale of non-current assets, including property and equipment, to raise cash. In the longer term, this can lead to reduced profitability for owners and shareholders. Creditors place importance on a business's liquidity as they seek guarantees that their accounts will be paid. So let's look at the current or the working capital ratio. This ratio helps determine whether a business is managing cash flows so that it can pay its immediate debts. So if current assets can cover current liabilities. A current ratio of 2-to-1 or 200% or $2 of current assets to $1 of current liabilities is generally acceptable, but ratios vary depending on the industry and the type of business. A high current ratio may indicate the business has invested too much in current assets that bring in a small return. A low current ratio, on the other hand, may mean that the business is more profitable if it is investing its resources in longer-term assets and generating more profits. So, how can a business control its current assets? Really, having excess inventories and a lack of control over accounts receivables leads to an increased level of unused assets, leading in turn to increased costs and liquidity problems. Controlling current assets requires management to select the optimal amount of each current asset held, as well as raising the finance required to fund those assets. So when it comes to cash, they need to ensure that they've got enough that the business can pay its debts, repay its loans, pay accounts in the short term, and that the business survives in the long term. When it comes to accounts receivable, the quicker the debtors pay, the better the firm's cash position. Some procedures for managing accounts receivable include checking the credit rating of prospective clients, following up on accounts that are not paid by the due date, stipulating a reasonable period for the payment of accounts, usually 30 days, putting policies in place for collecting bad debts. In terms of inventory, inventories make up a significant amount of current assets, and they really need to carefully monitor them so they don't have too much or too little. Too much inventory will lead to cash shortages because you've spent your money producing it. Too little will lead to lost sales because you don't have anything to sell customers. Inventory, again, is a cost to the business if it remains unsold because you still need to pay for storage, insurance, and so on. So how can a business then control current liabilities? Minimizing the costs related to a firm's current liabilities is an important part of the management of working capital. This involves being able to convert current assets into cash to ensure that the business's creditors are paid. So the first one is payables. Business needs to monitor its payables and ensure that their timing allows the business to maintain adequate cash resources. The holding back of accounts payable until the very final due date that you can pay them can actually be a cheap way to improve a firm's liquidity position because you're not parting with your money too early, you're waiting till the very last minute. Accounts, however, need to be paid before the due date to avoid any charges because then it could actually backfire and you pay a fee for paying too late. Some strategies can include floor plans, which is providing goods for a period of time before payment is required, or a consignment finance, so providing goods for a period of time and payment is not required until the goods are sold. In terms of loans, these are extremely important to manage because these can spiral out of control if they're not careful. There are costs for establishment, interest rates, there are ongoing charges you need to investigate and monitor. Short-term loans are generally a very expensive form of borrowing, and they really should be minimized the amount of times they use. And finally, overdrafts. Overdrafts are again a great short-term use of finance. However, they need to control these because they have regular payments need to be made. Usually, they have quite a high interest fee, so they need to make sure that they monitor their bank overdrafts and manage these to make sure that they can control their cash supplies. So, what are some strategies for managing their working capital then? Well, one is the use of leasing. So this is essentially you hiring something, an asset from another person or another company who has purchased the asset for it. So, for example, you may need to buy some machinery that costs $1 million. You don't have that $1 million, or you do, but you'd rather use that money on something else. So someone else buys it for you, and then you hire it off them. You pay them back every week or every month or every fortnight a small amount until it's all paid off to use it. So you're basically renting it off them. What this means is that A, you're freeing up that $1 million that you would have paid in one lump sum for a piece of machinery to now be used for other things. And two, it means you can then budget and say, well, every fortnight we need to make sure we've got X amount of money available because we need to pay for the use of this machine. As I said, this frees up cash so it can be used elsewhere. So therefore, the level of working capital is improved. They can also use sale and lease back. So let's say, for example, they already own that $1 million piece of machinery. They will sell it to someone. They might not get the full $1 million, but they may, say they get back $800,000 for it. And then they basically hire it back from them for a fixed amount over a number of years. So again, that frees up or increases liquidity because firstly, they get back money, which they can then use as working capital. And then they know every fortnight or every month or every week how much they need to pay back in order to use that machine. So I hope this brief video on working capital or liquidity management has been useful. The next video looks at profitability management. Thank you.